Hello and welcome to the Killik and Co market update. The big news this week has been the interest rate cut from the Federal Reserve. Investors have been waiting for this for a long time, and it is their first interest rate cut of 2025. This should be good news for economic growth and therefore for equity markets, as it will mean there is more money for consumers to spend and it will be cheaper for companies to borrow. Here's how the US rate has moved over the last 20 years. The rate is now 4.25%, which is quite a way below that 2023 peak of 5.5%. As we've mentioned many times in this video, the Federal Reserve has a difficult task of balancing economic growth with managing inflation. Here's what they said when they published this week's interest rate decision. Recent indicators suggest that growth of economic activity moderated in the first half of the year, job gains have slowed, and the unemployment rate has edged up but remains low. Inflation has moved up and remains somewhat elevated. And here's the latest Federal Reserve dot plot. The dots show where each voting member expects rates to be at the end of this year, 2026, 2027, 2028, and the longer term. The latest plot suggests that rates will come down to around 3% and will remain there indefinitely. This week, President Trump has visited the UK, and the coverage of the visit has been positive so far. The UK has announced that it has secured £150 billion worth of new investment from the US. Microsoft and Google will be investing in more data centres here in the UK, and private equity giant Blackstone will also be investing more. In last week's video, we did touch on the declining levels of foreign direct investment into the UK. Here's the chart again. It shows the net inflows of foreign direct investment into the UK as a percentage of UK GDP. The US is a very important partner for the UK in terms of investment. Here is the amount the US has invested into the UK in each year since 2015. The levels have been flatlining at just over $1 trillion per year since 2021, so an increase would certainly be welcome. More investment will hopefully inspire a bit of confidence into the UK economy. Retailer Next published its annual results this week, and its thoughts on the economy did not make for a very happy read. It said the medium to long-term outlook for the UK economy does not look favourable. At best, we expect anemic growth with progress constrained by four factors: declining job opportunities, new regulation that erodes competitiveness, government spending commitments that are beyond its means, and a rising tax burden that undermines national productivity. The problem appears to be that employment, particularly at the entry level, faces the triple pressure of rising costs, increasing regulation, and displacement through mechanisation and AI. And lastly, it looks as though the UK state pension is set to rise by 4.7% next April. The triple lock means that each April the pension will rise by whatever is highest out of wage growth the previous July, inflation the previous September, or 2.5%. This week we've had the relevant wage growth figure, which was 4.7%. Here's the trend over the last decade. We had that big spike after COVID, and there has been a general downward trend since then. The August figure for UK inflation came out this week, and it was 3.8%. You can see there has been a steady upward trend since April, which is largely due to the higher national insurance and minimum wage costs being passed on to consumers. It's very unlikely that the September inflation figure will be above 4.7%, and therefore 4.7% is widely expected to be the figure that will be used for the triple lock calculation. Moving on to have a look at next week's calendar, we are expecting results out from Accenture and Costco. That's it from us. Enjoy the weekend, and we'll see you next Friday.